Over the past few months, the dollar index and the yield on the 10-year Treasury have moved almost in lockstep. From October to March, it was a clear pattern. Yields up, dollar stronger. Classic. But then something changed. Since April, the correlation has broken. Yields kept rising sharply, but the dollar took a different route, falling below 104 and then even lower. Hi, I'm David, a macro and financial analyst with over 30 years of experience, specializing in currencies and commodities. And today, we are looking at a divergence that's more than just noise, one that may reveal something deeper about trust, policy, and the global perception of the United States. So, what's going on? The first key factor is the United States trade policy. In recent days, the Trump administration announced a 90-day suspension of tariffs for nearly all trading partners, all except one, China. In fact, tariffs on Chinese imports were increased, up to 145%, fueling fresh tensions and geopolitical uncertainty. And that matters not least because China still holds $759 billion in U.S. Treasury bonds. When your largest foreign creditor becomes the primary target of economic aggression, the risk is no longer just trade-related, it's financial. The more the relationship deteriorates, the greater the incentive for Beijing to reduce exposure to U.S. assets, and that possibility alone can spook the markets. The market's reaction was clear. The 10-year Treasury yield surged to 4.45%, yet the dollar didn't follow. On the contrary, it weakened, and this divergence isn't just technical. One reason lies in a loss of international confidence. The dollar has long been seen as a safe haven, but today, some global investors are pulling away, despite high interest rates, due to perceived political instability, systemic risks, and an increasingly fragile trade environment. Another reason is that monetary policy alone is no longer enough to support the greenback. Yields can rise, but if investors are buying treasuries only to hedge or speculate, without real conviction, the impact on the dollar fades. The divergence shown in this chart since April points to deeper underlying shifts. America is perceived as less reliable. The Fed's role in the global narrative has diminished, and the dollar is starting to lose its strategic advantage. When the correlation between yields and currency breaks down, the message is worth listening to, because it's not just the market that's shifting, it's trust. Whether this divergence continues or realigns will depend on what happens next, in policy, in global flows, and in confidence. But if the split holds, it may signal a larger shift in how markets price risk and how they see America. If you found this helpful, consider subscribing for more insights on macro, markets, and global risk. Support the channel for free with a like, and subscribe to stay updated. Don't forget to turn on notifications so you never miss a video. See you in the next one.